The April 6th session opens with the Nifty 50 under immediate stress. Global cues have turned sharply bearish over the long weekend, placing the market's internal technical signals in direct conflict with geopolitical reality. Today marks the expiration of the US president's deadline for Iran to fully reopen the Strait of Hormuz or face direct strikes on their energy infrastructure. Over the Easter period, the Iranian Revolutionary Guard Corps maintained the closure and launched new strikes on Arab Gulf state sites, signaling a refusal to de-escalate. Energy markets responded to the weekend strikes with WTI crude oil breaching $112 per barrel and Brent crude holding above $108. This sharp deterioration in the global backdrop is occurring just as the Nifty's internal technical indicators are reaching historically rare oversold levels. For traders, the conflict is clear. A rare technical setup that suggests a buying opportunity is currently trapped inside a high-risk macro environment. Because of this binary tension, any formal announcement regarding the Iran deadline will instantly override established technical levels, making capital preservation the only priority for the day. The current drain on liquidity began with the U.S. March jobs report, which showed 178,000 new jobs, nearly triple what analysts had forecast. This strong labor data implies the Federal Reserve will maintain high interest rates for a longer duration, which caused U.S. 10-year Treasury yields to jump from 4.31 to 4.35% on Good Friday. As yields rose, WTI crude oil simultaneously surged past $112, creating a dual pressure point of restrictive monetary policy and high energy costs. This combination of high U.S. yields and an energy shock typically triggers capital flight from emerging markets as global investors move towards the safety of the U.S. dollar. We can see the impact in the March data for India, where foreign institutional investors withdrew 122,540 crores from the domestic market. While the rupee has stabilized at 92.67 and domestic institutional investors continue to buy the dips. These factors offer only a limited buffer against the scale of foreign selling. Without a sustained decline in either crude oil prices or U.S. Treasury yields, the broader macro trend will continue to weigh on Indian equity valuations. Looking at the technical damage, the Nifty is currently trading roughly 1,940 points below its 200-day moving average, a level that marks a significant long-term bearish trend. However, the weekly RSI has dropped to 27.88. This indicates the market is mathematically oversold on a weekly time frame. This is a rare extreme. The current RSI reading is lower than the weekly bottoms recorded during the market capitulation of March 2020. This creates a setup similar to a compressed spring. The data suggests there is enough technical energy for a 600 to 1,000 point rally once the immediate catalyst resolves. Thursday's price action confirmed this tension, forming a long-legged doji candlestick. This pattern shows the market found significant support at 22,183, but lacked the conviction to push higher. While the technical fuel for a rally is present, entering the market early carries significant risk, as oversold conditions can persist until a geopolitical catalyst emerges. We can see how the derivatives market is pricing this standoff between macro risks and technical support. Open interest data shows a heavy concentration of put writing at 22,500. creating a temporary floor, while call writing at 22,800 defines the immediate ceiling. The 22,800 level acts as a critical pivot. A decisive close above this wall would signal a shift in institutional bias toward the bull case. Even in a rally, the 50-day moving average at approximately 23,200 remains the major medium-term resistance, likely capping any single session gain. Adding to the complexity is the India VIX, which is currently elevated at 25.52. At this level of volatility, the premiums for both call and put options are significantly more expensive than their historical averages.
Buying naked options today carries high risk of volatility crush, where premiums collapse the moment geopolitical news is released, regardless of market direction. Given the high-stakes environment of a deadline day, the execution strategy must focus entirely on protecting capital rather than chasing directional moves. Using straddles or strangles around the 22,600 to 22,700 strikes allows traders to benefit from a sharp move in either direction. Risk management is mandatory. Reduce position sizes to 30% and maintain 50% cash. If the deadline passes and military escalation is confirmed, the market's immediate floor is removed. Selling pressure targets the 52-week low at 21,744. Conversely, a deadline extension or diplomatic